If you've got $10,000 saved up, how can you put it to work to improve your financial well-being? Here are 5 things you can do to build your wealth. First up, pay off high-interest debt. While paying down debt is not a traditional investment, it can help you save on interest charges.
Debt has different structures. So there's one part of debt, like mortgages, would be a secured debt, that you actually have security behind the debt. But the unsecured debt part, which is like credit card debt, those typically have higher interest rate. And the reason for the higher interest rate is there's a chance of a default and there is no fallback option for the lender to recover that. So these higher interest loans are the first ones you have to pay back. Part of the reason is really compounding.
If you owe the bank $100 at an interest rate of 20% per year, after the first year, you will owe the bank $20 in interest. So in total, you will owe the bank $120. With compound interest, interest for the second year is calculated based on the first year's balance of $120 instead of the principal of $100. So the interest for the second year would come up to $24. So in total, you would have to pay the bank interest of $44 on the initial loan of $100.
If you're in a debt, that interest rate will compound over time, and then the principal might be minuscule compared to the amount of interest that you pay out.
Next, set up an emergency fund for rainy days.
Yeah, there are a few places that one can park their emergency funds. Of course, safest would be fixed deposit, right? And then the other option would be the Singapore savings bonds. These two options, they are safe. If at any point in time, if you want to liquidate and take the money back, you won't lose your capital. Of course, for fixed deposit, you may lose your interest, but you're not going to lose your capital. SSBs, Singapore savings bonds, you're not even going to lose your interest. Your capital is protected. Other options would be like treasury bills.
Treasury bills, or T-bills, are debt securities issued and backed by the Singapore government. T-bills have maturities of 1 year or less. Singapore savings bonds have longer durations. They're also backed by the government and considered low risk.
Another place that you can park your money will be some cash management accounts, right? The cash management accounts underlying it is just really some short duration bond funds. Another option would be a very short duration single premium endowment, 1 year, 2 years. A lot of insurance companies are launching it over the past few years. But just take note, whether T-bills, whether cash management accounts or these kind of single premium endowments, if you do want to terminate it, there is a risk that you might lose capital. But if you hold it till maturity, then you should not lose capital.
While cash management accounts may offer competitive interest rates compared to traditional banks, they may also be riskier. This is because cash management accounts don't usually have insurance coverage.
There are a lot of digital platforms, the robos out there. There are also some of these new financial institutions that have been set up, and they are offering similarly very high interest rate kind of instruments. Usually they position it like a deposit, but they are actually not deposits. They call it cash management accounts. They are invested into money market funds. But I think investors need to know that this is not like a bank. There is no SDIC protection. SDIC stands for Singapore Deposits Insurance Corporation. And you are really investing in short duration bond funds. They are bonds. They are fixed income securities. Right? It's just that because it's short duration, it's safer, but still there is no capital guarantee.
Our expert's third tip: decide on your investment goals. This includes how long you want to stay invested and how much risk you are willing to take.
So your risk appetite will be different across different people, even at the same age. Of course, older you are, then your risk appetite might actually go down to some extent because you have other liquidity needs, cash needs that you might have.
So if a person has only got 1 to 2 years, I wouldn't suggest that this person invests in either bonds or equities. I would suggest this person put their money in fixed deposit, money market funds. You can put into a T-bill, you can put into Singapore savings bonds. But if a person has got about 3 to 4 years, then this person can consider putting 100% of their 10,000 into bonds, no equities. But if a person has got, say, 5 years, then this person can consider putting maybe 20% into equities and 80% into bonds. If a person has got more time, say for example 7-8 years, they can consider putting say perhaps 60% into equities and 40% into bonds. If a person has between 10 to 15 years, I would suggest 80% equities and 20% into bonds. But if a person has got more than 15 years, then well, if you can take the short-term volatility, you can choose to put 100% into equities.
For someone new to investing, financial planners advise not to jump straight into picking stocks. Instead, consider an exchange-traded fund or ETF. ETFs are lower risk and give you diversification.
So if you are investing in stocks, you don't know which stocks to invest in, because there's different tools that are there. You have to read financial statements to figure out what will happen in future, and really no one can predict the future, even professionals cannot. But they have a structure of investing. So if you are not sure, if you're an initial investor, you're better off betting for the market rather than on individual components of the market. So index ETF basically is tracking an index, a market-wide index, and if the market goes up, it will go up together. So you don't have to specifically bet on single assets, but you can bet on the market.
If you're a new investor, start with something diversified. Start with a tracker, start with an ETF index that tracks the MSCI all country, because you are not just investing in the US market. Yes, about 60% of it is still in US. We can't avoid that because US is the biggest stock market in the world. But at least you have the remaining 40% in other parts of the world that is outside the US to diversify the risk from the US.
Finally, before starting your investment journey, invest in yourself. The more you learn about investing, the better you will get at managing your investments.
I'll say buy some good books to read about investing. Go and attend some courses, because the whole area of investing is actually quite wide. There are different approaches. Some, they are not even in investing, they are actually speculating. So try and find out as much as possible before you decide which approach suits you best. Now once you have decided on it, there are various platforms you can use to execute your investments. Nowadays there are plenty of online brokerages, there are also digital advisors, robo-advisors. Find out a bit more about them, their different style, their philosophy before you start investing. And if you are really going to execute an investment, my suggestion is that you start small. So using the hypothetical $10,000 that you have, I'll say start with $2,000 first, don't go in one shot. A bit of experience, try and sort of like know how it feels before you go in.